screen maybe. So eligibility, let's see. Yes, recording. Okay. So this particular program, the temporary buy down, is for purchases only. Eligible products, conventional fixed and ARMs, which is adjustable rate mortgages on primary and second homes. Okay. Prime jumbo 30-year fixed on a primary and a second home. FHA and VA on primary homes only, because those two products only allow for owner occupancy. No USDA or non-agency products. Can you close that door? Yeah, thank you. And then the tiers are a 321, a 211, a 11, and I can't see my other notes, and a 10. And we'll go through those each so that you see that as a visual. The benefits, okay. Great opportunity to help sellers get a property sold without affecting the sales price. What we've been seeing is that they're lowering the sales price. And in this instance, they can just credit towards this buy down product. Now, temporary buy down must be paid by the seller. It'll say this multiple times throughout this presentation, but everyone needs to understand that on the purchase contract, it has to be stated specifically that it is for closing costs or towards a buy down. And if it doesn't, then we've had to get addendums, but it specifically has to state that on the contract.
So no recurring and
non-reoccurring, reoccurring and non-reoccurring closing costs and or buy down.
Okay, so
yes, it has to say that.
Okay.
Yep. And the sellers like this because of course they don't want to reduce their purchase price. They would rather just give a credit, and they end up giving a credit probably somewhere in there anyways. And the benefit goes directly towards the borrower. A great way for a borrower to use excess concessions. I'm not sure how many excess concessions are happening. A lower interest rate for the first 1 to 3 years, allowing the borrower to have a lower monthly payment. So again, we'll go through this example so that you can see what that looks like. And at the end of this, I'm going to go over a scenario of a client that I'm working with right now that's in the Bay Area that was shocked to find out that her $1.2 million purchase price was going to have a $10,000 payment. So this is the perfect example of a program that we're going to use for her for a strategy. Let's see, borrower can use the monthly savings to do renovations, upgrades, buy furniture, or step themselves up to that payment until they can refinance potentially. We hope so, but we need to make sure they qualify with this payment because I can't guarantee that they'll be able to refinance. Who knows? It's the crystal ball, right? And so in a high interest rate environment, borrowers will be more than likely be able to refinance at a lower rate in the 1 to 3 years, which is, I think that is doable. I think that we're going to hit the actual recession at some point here, which means the rates will start to go down if they quit dragging this out. Just my opinion. Easier transition from renting to buying. With these particular clients, they thought their payment was going to be like $6,000. And I was like, wow, you're putting 10% down on a 1.2. The rate is high on a high balance loan. So their payment's $10,000. They thought it was going to be $6,000. So we're going to get them a little bit closer to that $6,000. Okay, so overview, seller and lender paid rate buy down. Now I left the lender paid in there because technically that's allowed. The problem with the rates today is that normally we would be able to give you a little bit of a higher rate and credit that amount towards the temporary buy down, but the rates are so high that there's no credit. The credit's not happening. So technically the lender can give the credit, but it's not happening in this environment. So seller, just tell everybody seller, paid rate buy down to help the borrower lower their interest rate for the first 12 to 36 months. Seller concessions can be used to pay the upfront fee with the seller. Paid temporary rate buy down. The lender paid LLPA option can be used to cover the buy down cost on the lender paid temporary rate buy down. This thing is like repeating itself. Borrowers have the seller's concession, or would like to have a lower interest rate in the beginning in their mortgage for a lower monthly payment. So borrower must qualify with the initial note rate. So when we're looking at this, the rates, for example, these clients that I'm talking about are at 7.625. They have to qualify for that, meaning that their back end on a conventional can't be higher than 45%. Okay. They have great income, but just because they qualify for that doesn't mean that in real life they can actually make those payments, right? Let's see. This is all whatever. Okay, so let's look at this. Let's look at our examples. So on a 3-2-1, there are guidelines on this. So for example, a high balance conventional loan, they're only offering the 2-1, not the 3-2-1. Okay, so I just wanted to make sure that everyone's clear that not everyone can get that 3-year lowering of payment. High balance is only allowing a 2-1 or below. Okay, so but on a 3-2-1, it would be 3% lower on the first year, 2% lower on the second year, and 1% lower on the third year. Year 4 in that example goes to the note rate. Okay, and so on. I mean, you guys get the point, right? It tiers and kind of steps them up to that note rate. And hopefully within that amount of time, the clients will be able to refinance. And the cool thing about the temporary buy down is whatever is left of that seller contribution or concession goes back to the principal balance. So if they refinance after year 1, whatever's left based on that credit of prorated credit, the clients get that put back towards their principal balance. They don't get a check, but they get the money back, whatever that prorated amount was. On a permanent buy down, say you know, the rates are 6%, you pay to buy it down to 5%, that money is gone on a permanent buy down, the way that we would traditionally do it. So I like this, that they actually get the money. So here's some examples. So this one is the 3-2-1. So this, again, I like to look at these because it's a visual for people, okay? So 3-2-1, year 1, and these rates are not even close, so don't even start with me. But 2%, the payment would be $12.94, and the difference would be $5.85 a month, right? Annual savings. So that's another cool thing about it. I mean, you're saving in interest on this as well, because we're paying, you know, the interest is front loaded on a loan. Year 2, their rate would tick up 3%, $14.76. Their savings a month is $403. Their annual savings is $48.36. You guys following me? Okay. So, and then on this particular example, which was at the top, it says loan amount of $350, interest rate of 5%, right? The cost to the seller, where it says buy down amount here, the cost to the seller would be $14,352. Okay, so that's what you as the selling agent would have to ask the listing agent within your contract if the seller is willing to credit $14,352.
Where did you get that $14,352?
Are you on the 3-2-1? The last line. Yep. So the last line, $14,352.
Oh,
yeah. And so when we do these, that's why I tell people they have to call me, because I plug in the numbers and it does all the calculations for me, and it'll tell me what the seller amount is. Yeah. So that was the example of the 3-2-1.
And that's dollar for dollar. Whatever the seller pays, that is the amount of savings within that full time, like you said.
Correct.
3 years, 2 years,
Yep.
whatever. Okay. Gotcha.
Exactly.
Question?
Absolutely. Go for it, Mama. Yes.
So, I can't listen that fast.
Go. Yes. That's okay.
Oh, yeah.
Yeah.
Back to the buy down option.
Yes.
When we talk about buy downs, could you, I mean, my head just went, what?
Yes. Woo. Okay. So,
Slow down and say that again.
yes. So go back to the buy down options where it has the, yes.
I'm on it.
Yep. Okay. So on most loans, they're going to allow the 3-2-1 option, but for a high balance loan, so something that's outside of the conforming loan limit.
What's that number?
It depends on the county. So yeah. So yeah.
500,000 or 600,000.
It's some,
No.
yeah, it's
It's
739.2 or something, some random number. Don't quote me. Somewhere in that range.
Have a high balance.
That's
loan.
over the conforming loan amount.
So you have an 800,000.
Yes, they will only allow you to do the 2-1, not the 3-2-1. Yes.
Who's they?
The
Yes.
lender or the agency. Yeah. So Fannie Mae, Freddie Mac. Yeah. Oh yeah. No. Yes. Who knows? I'm sure it has to do with. I'm sure it has to do with servicing. Yeah.
A lot of money.
Yeah.
And seller pays a lot of money because it's
Yes.
But is it typically?
It's probably actually adjusting value too much. Think about it. I mean, she just said on a 350 loan, you're getting a $14,000 credit
Yeah.
or wherever that number was. Well, on an $800,000 loan, you're getting like a $50,000 or $80,000 credit. Then they're gonna start seeing people, let me bump my price up by $100,000. Then you're adjusting values, which really affects the overall market.
That's true. But that's a lot of credit from the seller.
Yeah, it is.
Yeah. Well, it's better than sometimes lowering their price.
By
Unfortunately, I
100,
think we're getting into a multiple offer scenario already. We've got beat out on one last week it was listed for 750 and it went for 900,000 or something. And we were it's in San Leandro, right, the area, and they had offered 825 or 850 or something, and they still lost.
Wow.
Yeah. So and that was 15 offers on that particular one. So we're already in a multiple offer scenario anyways. So
Certain places, yeah,
so,
especially there.
it just depends. So did that, yeah, okay, stop me when I'm going too fast. Because obviously in my mind, this all makes a whole lot of sense.
So we're back to the 2-1.
Yeah, so we were at the 3-2-1. The 2-1 example is exactly, I mean, I gave you the example so you guys could have a visual on it. But I don't think we need to go through every single one. But this one is a 2-year, right? And then on year 3, it adjusts to the note rate. And then sorry, go ahead.
So, if you're not available or favorite lender isn't available,
Yes.
we're trying to write an offer and we're trying to figure out what the seller
You need your lender.
would be. Is there a kind of a percentage rate? I thought it was like 3%.
Not on the buy down piece. So if you're looking at just doing a closing cost credit, you can figure, depending on the loan product, it's 2 to 3%. But the buy down is going to depend on what that rate costs for that particular day. And you're not going to know the rate sheet. You will have to talk to your lender. Yeah, whoever your lender is.
So we estimate.
But I'm available 7 days a week. So just so you know.
Yeah, sure.
She's like, so yeah, no, teasing you. But yeah, so you do have to get with your loan officer.
So that rate
For them to
fluctuates
give you that
based
number.
on yield spread and
Yep,
service release premium.
Absolutely. I know. I thought there was, at first they gave us a formula, but then when I started working the formula out, it wasn't correct. Yes. And if you're trying to, you don't want to go back to the seller multiple times. Oh, never mind. That's the wrong number. You want to get an exact number.
Just ask for $1 million.
Yeah.
Cover it.
Just 25,000 on everything.
I don't know. I ran into a situation where it was a problem getting that leftover money applied to
Your
the
guy,
seller
your
credit.
bet property.
So since then, I have this whole verbiage
Yes.
that I put in so that it's included.
That's good. Yeah.
I don't know if you're seeing any pushback from any lenders saying, no, they can't have that extra money.
It depends on the verbiage. Yes. So the leftover money was from credit for closing costs?
No, for the buy down.
Oh, for the buy down.
And they wouldn't allow the extra. So
Yeah.
we didn't know,
Yeah.
and the seller came back and countered not what we asked for.
Right.
So, and at that point, with things changing so fast, like you said, you gotta call and find out.
Yes.
What that is.
Yes.
The exact amount. There was
Yes.
some left over and then there was a problem getting that leftover money applied.
And sometimes they just lose out on it, which is awful. The buyers lose out on
Yeah, we don't
Yeah.
want that.
no. Like sometimes an extra home year on the home warranty doesn't quite capture the money. That's always the go-to, right?
Mhm.
Do a 5-year instead of a 2-year. Yeah.
There's a max of 6% of price. Oh, that's true. There's a maximum.
Unconventional. FHA is only 3%.
I was going to say it depends on the loan product. Yeah.
How about USDA and VA?
I don't have it in front of me. I
Okay.
do have it written down somewhere, but I don't have it in front of me.
So 6% would be
Conventional.
conventional and 3% is.
FHA.
I know I should have brought my notes on that. I don't want to quote it because then it's probably going to be changed by the time I I'll send you an email
The last
or
time
send
I
it to you guys.
checked, that's right.
Yeah.
So-
Yeah. I actually did a whole presentation on that because that was very important. Okay, so 1-1 and then a 1-0, meaning it's only bought down for a year. Okay, so it works exactly the same. It's just tiered differently. And so the particular client that I'm working with right now 1-2 purchase price. They have 10% down. It's a high balance loan. They are definitely payment shock, right? Because they're renters, they're in Santa Clara County. And so this program works perfectly for them because they literally thought that their payment would be $6,000, like I mentioned, and their payment with taxes and insurance and mortgage insurance is $10,000. And 1.2 doesn't get you anything in Santa Clara, especially because they need like a 4-bedroom house. And so this steps them closer to where they need to be. And what we're doing is they have a little bit of extra money. They're going to pay off as much of their debt that they can. They have like 80,000 more. So they're paying off multiple cars, a bunch of credit cards, and then they'll have a little bit in reserve. So the strategy is to get rid of an additional $2,500 to $3,000 a month in payments so that it helps them get closer to that. And then also keeping some money in reserve to supplement the difference between what they're paying in rent and even with the stepped down payment, so that they can supplement over that 12 months. Now, again, strategy, husband is expecting a giant promotion and raise. So in the next year or two, they're expecting that the 10,000 will be fine. But it's a strategy, right? You go into it because with the rates being so high. So, hopefully, we pray that the rates are going to come down and they're at 7.625 because they don't have great credit scores. Their credit scores are in the 6s. So that's rough, right off the bat. But this strategy works really well for them. So now the realtor has to go find them a 1.2 in Santa Clara because they're ready to go now. They're ready to shop. Any other questions out there? Are you monitoring questions?
I'm monitoring.
Okay, good. What else?
The 1-1. So that's 2 years of 1% buy down.
Yes.
Okay, that I actually never heard of.
Yes. So most people don't choose that. I mean, because they want a couple years worth of, working their way up to the payment and giving them enough time to potentially refinance if the rates come down.
Okay.
Right. What other things have we run into? I haven't really run into problems with this program. People love this program and it has worked out really well. And for these one particular clients, I think you have to find the right fit within a client, right? Every program and situation doesn't work well for people. And so I'm very careful when I'm giving this option to people to make sure that they understand that the actual payment's 10,000, you're going to get there at some point. So you need to have some kind of an exit strategy for it. Kind of like a hard money loan, right? You want to make sure that you have an exit strategy to get out of that. But I think that's it. To end with, though, I'd like to say that the reason that I get to do this is I'm Gary's favorite lender. And so why would you use me? Okay, let's talk about that really fast. So Nordstrom service. What I was just telling Cheryl was I work 7 days a week, 8 a.m. to 8 p.m. You can catch me. I'm working the weekends because I know that you guys are out at 8 o'clock at night on a Saturday trying to write offers or change things on a Sunday. So I'm available for that. We do I'm a mortgage broker. So we're, approved with probably 40 or 50 different either investors or lenders. We use probably 5 of them on a normal basis. I do every single product agency wise. So conventional FHA, VA, USDA, lots of down payment assistance programs. As I mentioned before, the 20% down dream program is on pause. And I can give you direction on that. Non-agency, meaning DSCR loans. I can do 35 states without even being licensed. That's just the way that works. Hard money loans, stated bank statement, asset driven, 40-year interest onlys.
Wait, what?
What?
40-year interest only? There's a loan like that? Again?
There is, but they have to, it's a small box.
Oh, okay.
So it's expensive. You want an exit strategy, and there is, the rate's high.
Oh,
It's not agency rates, right?
Oh, okay.
Yep. I-10 foreign nationals. So all of those type of loans we can do. The only thing I really don't do is commercial. And I do refer out my reverses because those are specialized. Although I'm certified, it's just a lot. Yeah. I think that's it.
And Steve Hillier chimed in on the chat that says, and you're amazing.
Thanks,
So
Steve.
what's your favorite down payment assistance, and do you think that the state will find some more money to cap up some more?
Right. So, yeah, so what I was saying in the beginning was they had announced there was 300 million, 150 million a year. So for this year and next year, that went in a week. The 150, as far as we can tell. I've heard rumors, and that's all that they are, is that they used the 300 million in the week. So we have gotten no direction on that at all, but it makes sense. I mean, think what Kelly and I were talking about this before, that 300 million, 100,000 per borrower, right? Because we are in California, 20%, right? 3,000 loans, right? 3,000 loans. We do 3,000 loans in a month. So it was bound to just, right? It should, like I said, it should have been $1 billion. It's not, 300 million over 2 years is not a lot of money. So what I was telling them is that I've been telling my clients, do your application, pay the $99, get your counseling done. So, and that lasts for 12 months so that if they do find more money, the clients are ready, because it's going to go fast again, right? Even if they put out 500 million, it's going to go just like that, because everyone's now on high alert that they want that product. And I wasn't even a big fan of it. So everyone's super jazzed about it, but I was like, I don't know. So yeah, so down payment assistance, normally it's a CalHAPA product, and we do the 3-pack. We do a conventional FHA with a My Home and a Zip. And that takes care of almost all of the down and the closing costs. And then if you can get a seller credit, sometimes they get their EMD refunded to them and they come in with 0.
So what's that rate bump up to though from current?
Yeah, so it's high 7s. Yeah, I mean, and the cool thing about the dream was it was only 6%. We were like,
That's
what?
right, we did. We
Yeah, yeah. So that was amazing. That was the one good thing I was impressed with. But yeah, so just the regular 3-pack, I think, is the best. And there's so many different county programs and equity shares, kind of like what the dream was. But the 3-pack is just a go-to, and we know it, and we close them. I mean, I do probably a dozen of them a year. Oh yeah, oh yeah. Well, in a high 7, and because it's a high risk product. I mean, these clients are literally coming in with no money really, right? So they have to make sure that that they get their money somewhere. Hopefully, I don't know what the default.
But even in a $400,000 home, which you're lucky to find it.
Right.
What's that payment?
It's high. Yeah, it's
It's gotta be close to $4,000.
It is. Yeah, yeah. It's like in the forest.
3,500, yeah.
So what I recommend.
Cheaper to rent.
Well, or it's cheaper to go find a relative or borrow from your 401k and do a regular FHA loan with 3.5% down. That's what, so I always get people qualified on the down payment assistance program. And then we talk about options. Do you have a grandma that's just dying to give you some money? I mean, amazingly enough, everyone's like, oh yeah, she said she would, but I wanted to do it on my own. I'm like, well, $4,000 payment or $3,000 payment. And then you don't have 3 loans either. You have 1 mortgage. So I usually try and push them that way, but we've done a ton of the down payment assistance. And you have no other options. Buying is better. Buying is better than renting, regardless, especially in California.
Yeah.
Yeah.
So
Anything
you said real quick. So you said the 3-pack. You have to make payments on each of those.
No,
loans?
just the first.
Just the
yeah,
first.
and one of them's a grant, so one of them goes away
After how long?
3 years.
Okay.
And then the other one is simple interest, gets paid back at the
gotcha.
end.
Whenever you refi or
Yep.
either way. Okay.
Yeah.
So it's similar to the equity share program.
No,
Well,
the equity share was,
no equity share.
yeah, and so no equity share, which is a big thing for me. I'm like, I want my equity. But that 20% or that 20, yeah, whatever it is, it's up to 20%. So it didn't mean that everyone was going to get the 20%, but up to 20% is a loan, but you don't make payments on it. But you can't refinance, right? Unless you got that 20%. And you and if you sell and you're short, it's a short sale. So
they didn't take they only wanted the equity position. They won't take the loss also.
They're not taking the loss. Absolutely not. So there's little caveats in there. I think if the clients that I had pre-approved on it, then ended up backing out of contract because he couldn't get the 20%, and he couldn't come up with the 10. We needed him to be at least 10%, and he couldn't come up with the extra 5. But that piece, you know, that not being really flexible is an issue, you know, that could bite them. I mean, the chances are slim. If you're going to live in it I tell people, if you're going to live in the house for 5 to 10 years, you're good to go. You'll be fine. It'll be fine. But if you're looking to move up and we're having 3 more kids in the next, you know, couple of years and you need a bigger home, then you may be stuck in the house, which wouldn't be so horrible, but you know, everybody figures it out. Yeah. Anything else?
Good for me.
Thanks everyone that's listening, and in the archives that get to be in there, call me. Oh, one last thing. Boom. So on here, if you just, it's a QR code, it'll take you, you can give this to clients and it'll take you to my application to apply online.
Yeah.
Oh yeah, that would be good. Let's see, I think that was in the beginning. Yeah, okay. So phone number is 916-541-6049. And then email is Stacey@unifiedhl, like homeloan.com.
Stacey with an EY.
CEY. Yes. CEY. Yes. That's the right way to spell it.
The right way.
It's old school. Okay. All right. That's it. That's all I have.
Awesome. Thank
Call
you
me
very much.
and I will give you lots of information.
Cool. The rest of you online, thanks for joining us. And you guys can take a hike. We're all going to party here at the office.
And we get the gift card too, because you guys aren't here.
All right. We're good?
Yep.
Cool.